what we'll do is just walk through sort of why this stuff is really important for founders. And one of the things that we learned very early on in the business was that there's a big knowledge gap here, which is why we're excited to dive deep in this with you today. So what we found through surveying a few dozen founders was that the vast majority of repeat or experienced entrepreneurs knew to get this kind of out of the gate early on in their company. But first-time founders are often unaware of why insurance is important. So the first is that things can happen to good companies, and when insurance matters, it really matters in terms of, frankly, the survivorship of the company. There are a lot of examples that we've seen out there of companies being sued around their financing events, as employees tend to come out of the work around big major milestones. Fortune 500 companies go after small competitors in an attempt to squash them and rack up hundreds of thousands of dollars in legal bills. We've seen cyber events around that have the potential to sink a business. And so repeat founders or folks that have been around the block have seen this before and typically get it in place. But it's often, for most first-time founders like myself, you don't really know to get it until it's required by the people that you work with throughout the business, whether it be to hire employees, to sign big customer contracts, to raise capital, sign your first lease. The counterparties that you're working with are they've seen what can go wrong in a business before, and so they require coverage as you grow. All right, hopefully everybody can see our screen here now. Cool. All right, so as I mentioned, these are products that, even if you don't necessarily get covered early on in the business, it will be required as you hit really important milestones. And so what we're going to do today is walk through each of these important milestones and the insurance that's typically associated with that required by your business partners. Please, ask questions in the Q&A, and we'll save time at the end to work through as many questions as we can. So the first one is that it all starts with people for a few reasons. One is oftentimes, hiring your first employee and getting the workers' comp that is required in every state is the first insurance purchase that we see a lot of companies make. But I would say similar to auto insurance, where you're required to have the bare minimum, oftentimes it's really a good idea to have a little bit more than that. So we'll talk about employment practices, liability, and a couple things I wanted to highlight before handing over to Melissa to get into the details is that this is one of the least talked about but most important risks that businesses face. The claims data shows that 40% of companies over the course of a lifetime get sued by an employee. You're 6 times more likely to experience a financial loss here you are from a cyber event. And yet, cyber gets a lot more attention in mind share. And so I'll hand it over to Melissa to talk through some of the details.
Thanks. So we're going to start with workers' comp, which is a statutorily required coverage. So you do not have the option here to not purchase it. But I think the biggest key point here is what does it do? So it protects you and your employees. A key piece there is you and your employees in an event of an accident or an illness. So it doesn't have to just be someone slipped and fell. It could also be mental anguish or stress, anxiety, things that unfortunately can happen on the job. Who needs it? Again, it is required. So anyone with employees, every state is different with respect to the costs as well as the limits and the types of coverage that are required. However, it is a required coverage in all 50 states. Why it matters? Unfortunately, as I mentioned, accidents happen. So it's important that you provide the protection for not only your business, but also your employees in the event of a fortunate incident. Scenarios here, I think it's fairly straightforward, but a coffee robot burns your PM. They need to go to the hospital. This would be covered by your workers' compensation benefit program. Let's say that person is unfortunately out of the office for a week. That would also be something that would be covered under workers' compensation. So Travis touched on this a little bit, but employment practice liability is, as mentioned, not a very common term, sometimes referred to as EPLI. But what it does is vital to your organization, especially as you're growing and adding new employees. So from hiring to firing, EPLI coverage provides protection for your business in the event of an alleged discrimination, sexual harassment, wrongful termination, etc. Key point there, it doesn't necessarily have to be a actual discriminatory act or sexual harassment, it's just alleged. And so building a team is obviously vital to the growth of the success of your business. but that doesn't come without risks. So the bottom line here is if you haven't, you're looking to build out your team, you need this coverage. No industry, big or small, is immune from employment-related risks, especially for those in California, which has about a 45% higher chance than the national average of seeing a claim within this coverage. Furthermore, for folks who do not have this coverage, you can see costs of upwards of $125,000 per claim. And sometimes these claims can take over 400 days to rectify. So we highly recommend the coverage for folks who have employees or who are actively growing their teams, as it is vital to protecting your business in the event of a potential claim.
So now that you're hiring a team, one of the first big milestones as a business is signing that first lease. And anytime you're signing a lease, they're going to require two kinds of coverage. It's property and general liability. For the landlord or for the bank on the other side of your letter, they're concerned about your everyday sort of theft events. They're concerned about litigation that could potentially make you a vulnerable tenant or lending partner, and all sorts of other sort of unexpected things that happen throughout the business. You might also hear these referred to as business owners policies, where they bundle these coverages together for smaller early stage companies. And so again, I'll kick it over to Melissa to talk through general liability and business personal property.
So what is GL? GL is the fundamental coverage that every business owner should have. It provides coverage for small and large organizations at basically every stage of operation. So it covers things like bodily injury or property damage, as well as advertising injury claims caused by your business operations or products and occurring, or again, that infamous word, allegedly to have occurred on your premise. So who needs it? Again, everyone, whether you're big or small, or even an independent contractor, you and your business or product have the risk of causing harm to someone or something and being sued for just about anything. Think about it this way. You wouldn't drive a car, granted you're legally required to, without insurance, but you also probably wouldn't think about doing hazardous activities like skiing, biking, or taking a scooter down Market Street without insurance, aka health insurance. So why would you build your business any differently? Some good examples here. Your client is coming to the office and slips and falls on spilled coffee. If they're injured, this would be a covered claim under your general liability policy, as well as the competitor sues you, alleging that you used their advertising idea in your advertisement. Again, any allegation within this would be covered under your commercial general liability policy. Another piece, as Travis mentioned, was BOP. So another coverage enhancement under a BOP policy or a BID policy is what's called business personal property. Then your standard property insurance, which most folks understand who own property and obviously are in the business of covering that property itself. This is more specific to things that you have within your business. So laptops, smartphones, really the vital pieces of technology and property that you use in order to engage in your activities. So who needs it? Pretty much anyone that has these things, which I know for sure are all the participants on this call who are calling in a laptop or some sort of smartphone. But really anybody who has stuff per se that is by your organization.
So now things get a little bit more complicated. The scenarios we've talked to before are that every business needs. And now as we start talking about the coverage that customers require, or that as you launch a product or just good ideas hit in place, feel free to fire with a question here. What typically happens is let's say you're in an early stage company selling into a Fortune 500 enterprise, and you're really excited. You land that first pilot, let's say it's for $100K. And then you get that contract that requires $10 million in coverage. You get a quote for it, and it costs $50,000, $60,000 a year. Oftentimes, these terms are very negotiable, and so we really encourage companies to work closely with whether it be Vouch or your insurance broker to identify what is the right level of coverage to have in place. And so the reason we say always be covered here is, you're as a business, you're focused on, if you're selling, always be closing. And in order to do that, these insurance terms can actually hold up contract negotiations pretty substantially. If you think about it, putting yourself in the shoes of the Fortune 500 company, they're used to working with more mature businesses. And so their insurance requirements for their partners are designed with that in mind. Again, oftentimes we find that they can be flexible, and what really we encourage folks to write coverage in place for your business before these negotiations so that you can go to them and really present yourself as a credible counterparty that's prepared. And they're going to have a lot more, what we've seen is that they'll have a lot more faith that you do have the right thing in place for your business, and be more comfortable sort of meeting you where you're at versus starting from scratch. And so we really encourage folks to get this stuff in place when you're launching a product, as you know you're going to be going to these conversations. Some of the more important coverages that we see required by customers are errors and omissions and cyber. But frankly, we see things like general liability, crime coverage, and other coverages required as well. Just depends on the category you're operating in and the kind of folks you're partnering with. So with that, I'll hand it back to Melissa.
Thanks. So errors and omissions insurance, also referred to as E&O, as well as professional liability insurance. This coverage protects your business against claims that allege that you made a mistake in performing professional services for your clients, or that you've professional service for your client that you agreed to do. And in doing so, your client that error resulted in some financial loss for your client. Even if you're not ultimately found to be responsible, again, allegations are claims as well. It is important to understand that litigation can be costly to your business, so being prepared and having this coverage is vital. Furthermore, tech firms can have a higher exposure here, given that the laws are unable to stay ahead of tech trends that hit the market, which causes knowledge gaps, both within the industry as well as your clients, and this can lead to miscommunication and ultimately lawsuits. Generally, we recommend this coverage for folks in the enterprise, fintech, and folks who are providing professional services. But truly, anyone that is engaging in contractual obligations or putting forth services that are required for their clients, it would be important to evaluate this coverage. Secondly is cyber. So I think everyone is pretty familiar with the term cyber, but maybe not so intimately with what it actually provides coverage for. So in the event of a cyber incident or a data breach, cyber insurance covers services needed to reduce the likelihood of a lawsuit. This would include forensic analysis, breach notification, support and costs, as well as credit monitoring services. If a lawsuit does occur, then a cyber policy would provide additional coverage for things like defense costs, settlements, or judgments. It is really important to note there's two key distinctions in the cyber policy. So it's going to be the first one being first-party cyber coverage. And so this is in the event that your own computer system is compromised by a breach or attack. So anyone who is storing customer data is at risk, certainly, for a first-party cyber loss. Under this form would provide costs associated with notifying affected customers, as well as offering services, as I mentioned, such as credit monitoring. The second piece is third-party coverage. And so this is in the event that a client's system is hacked or breached. So if a company is hosting, maintaining, or somehow manipulating a client's data, so think about IT consultants, software and app developers, web hosting businesses. They have a third-party risk and could be sued for causing or preventing attack. I think the most important example here is actually the Target breach, which most people are familiar with. It wasn't Target's system that was directly attacked. It was their third-party consultant who there was basically an access for an attacker to get through to their system via the third party. So long story short, this coverage is vital in the Internet of Things world that we operate in. Obviously, data is king, especially for tech companies, and so protecting it is certainly be one top priority.
Awesome. So next come investors. And so typically when you raise a price round, we often see this at the Series A stage as an investor joins the board. And at the end of the day, they're looking to protect their interests as well here. And one key note is that it's not just investors that is the right milestone to get directors and officers coverage in place. If you're operating in a highly regulated or litigious space, we often encourage founders to get this in place to protect themselves as well as directors in the business. I'll let Melissa speak to exactly why that is. But as you have different, whether it be litigation events or otherwise, sometimes the individuals can be named in those lawsuits as well. So this is really important protection for the directors and officers of the company. It typically isn't required until you have that outside board member come in because, again, they've sat on dozens of boards, they've seen this before, and we tend to see that the more experienced an investor or their fund may be, the more likely they are to really have stringent requirements around this. We find these requirements negotiable. Typically, if you're a fund that's doing consistent check sizes, you have pretty consistent requirements that are less flexible. But again, it typically comes into play as you raise a price round, or if you're operating in a space like fintech, for instance, where we encourage folks to get it in place early on. But also just highlight that there's certain coverage, like crime coverage, that we think is critically important for startups, as you have abnormally high cash balances, relative to the size of the business. We saw this ourselves around when we announced our Series B. You see, that's when the spear phishing attacks, et cetera, tend to come out of the woodwork. And so there's often some confusion around crime versus cyber. So again, I'll let Melissa speak to the differences there. But I would just highlight, echoing on the cyber conversation as well, that so much of this really does come down to your people and process, back to where we started the conversation. 4 of the 5 largest cyber breaches over the last few years were driven by internal sort of human-related failures. And so investing in your people, your process, training may seem like it's way too early for that for most. Those are some of the things you need to do to protect not just your business that your team is really counting on for success, but especially as you start taking on outside capital and the expectations are that much higher. So with that, I'll hand it over to Melissa.
Great. So D&O, directors and officers coverage, as mentioned, is really vital as you start to build out your board, and is also a requirement, really, of most board members. So this coverage gives financial security and peace of mind to executives and board members when making business decisions. The idea is that it provides your company with financial reimbursement, allowing you to honor indemnity agreements with the Ds and Os of your organization. Essentially, the contractual promise to cover legal fees, judgments, and settlements that may occur, that you may incur, while performing director or officer duties. Some very common D&O risks are things like inaccurate disclosures, reporting errors, regulatory proceedings, security claims, as well as mergers and acquisitions. A D&O policy definitely varies based on the company, what stage you're in, and the limits and coverages that you're actually getting. But it is really important as you think about getting investors, building out your board, building out your advisory board, and really sort of protecting the people that are making the strategic decisions around your organization. Crime insurance. So this is another coverage that's really important as you start to build out your employees. The insurance provides coverage for things like employee theft, embezzlement, forgery, computer fraud, as well as funds transfer, which I think a lot of folks are potentially familiar with, as Travis mentioned, spear phishing. So folks coming in and sending an email saying that they are the CEO of your organization and that they need you to wire $500,000 immediately to this account. That would be something that could potentially be covered under a crime policy. Every year, crime costs in the U.S. billions, and small independent businesses often feel the largest impact of that. So we recommend buying this insurance if you have 5 or more employees, or again, growing out your organization, your business processes financial transactions, you have employees that have access to sensitive data, or you hold inventory on hand.
One thing I just wanted to highlight before we move on here is if there's one piece of advice around fundraising that we give to founders as it relates to insurance, it's to get covered before you announce your round. A lot of times people put this off as one of those checklist items that you don't want to think about. But again, really, really strongly encourage folks to get covered before you announce and, sort of the bad guys come out of the woodwork.
Certainly. Key person. So this coverage is very similar to how you think about life insurance. The idea here being that the beneficiary is actually the organization versus a loved one or child. So this pays the company and the benefit in the event of a key person within the organization that's identified at the time of binding the policy dies and or is disabled. And so who needs it? It's truly early stage companies who are dependent on one or two individuals in order to build their organization. The idea being, it's an unfortunate topic and conversation, but if the founder of a company has recently raised and is struck by a bus, there's a lot of key strategic decision making and information that goes with that person. And so the financial burden that may come to that organization based on that event, this coverage would step in and help protect the business in the event of a death or disability. Coverage is written typically on an individual basis. So the idea being that age, gender, health, and historical sort of medical conditions are all pieces of the writing that goes into the cost of this coverage. So it's hard to give an exact number as to what it costs. It really is dependent on the individual themselves, as well as the coverage and the terms that you are procuring. So some other common coverages that we'll go into a little bit more high level, but hired and non-owned auto. So this, in contrast to your commercial auto, is for coverage when you do not own the vehicle. So for things like riding in business or in rental cars, or even an employee using a personal vehicle to drive to a conference or a meeting, this would provide liability coverage to your organization should an event or an accident happen. Fiduciary coverage, this coverage is for employees or employers who are building out 401k plans, other type benefit plans. It actually is routinely purchased with employee benefits liability. So the idea being that it provides coverage for both proper coverage to your business when administering employee benefits. So failure to invest plan assets prudently would be a type of claim you'd see under fiduciary, as well as negligent investment practices. In contrast, employee benefits liability coverage would depend on the type of benefits you're offering within your business, but this coverage protects the business and plan administrators for the delivery, enrollment, and the administration of the benefit plan. So an example here would be if an employee was failed to be enrolled in a company-sponsored health plan, or failure to change a beneficiary when they ask you to do so. And lastly, media liability coverage. This is a specialized type of E&O, or errors and omission insurance policy, that is designed specifically to protect organizations like publishers, producers, or other media-related businesses. We all know social media has contributed to a lot of different legal implications. And so it's important that use as things arise. The coverage protects from things like invasion of privacy, libel, slander, and defamation, as well as plagiarism and copyright infringement.
All right, so with that, we'll answer a few questions. And looks like there's a few that have come in on the Q&A. I'll pick up this first one here. Someone asked, they'd be interested in more detail around insurance for financial solvency. And so wanted to clarify there. On one of the slides, we referenced financial solvency as a key risk topic, and it's often why you see your counterparties requiring insurance. And that's because in the event of a spear phishing attack or a really substantial lawsuit, those events can threaten your financial solvency. I wish there was insurance for financial solvency. That doesn't exist, at least yet. But these coverages are really important to protect that event from happening to your business. And again, if you think about your customers or your investors, your company being around for the long haul is obviously important to them, and that's why they require these coverages.
There's another question that says, are there new workers' compensation policies for distributed remote workers? So no, workers' compensation is a fairly antiquated coverage. And again, it's something that is required at the statutory level and is managed at the statutory level. So it's regulated and implemented based on the state. For remote workers, basically the way it would work is that you would provide a policy. Let's say that your office is in California, but you have a couple of remote employees in Florida. You would have to provide coverage based on where their payroll benefits are paid out of. So you would have a California-based work comp policy as well as a Florida-based work comp policy. So the next question is, if you only employ contractors, do you still need workers' comp or EPLI coverage? I'll touch on the first part. So independent contractors, this is an interesting topic given AB 5 in California, which is currently playing out, and the definition of independent contractors is certainly up for debate in several different sectors. However, if you have someone who is, truly an independent contractor, they pass the test, you do not need to provide, you are not legally required to provide workers' compensation insurance for them. Typically, especially if you're using a third-party organization and you're hiring them via that organization, they will usually provide a lot of the benefits needed for those employees, but you are not required to provide work comp. EPLI coverage typically does not provide coverage for contractors. It's just going to be for employees. However, if somebody is potentially coming over as it's switching from contractor to employee, you would certainly want to think about that type of coverage.
So while we're talking about workers' comp, it looks like we got another question. By workers' comp just for founders, haven't hired any employee. And I think the answer to that really just depends on how you structure the business, but typically no.
And I would say it's probably depending on the state and the state requirements, but typically no. If it's just you and you're in a WeWork or in your laptop, that would not be something that you would need to provide workers' comp. However, I am not an expert in every workers' compensation law in all 50 states. So it would certainly be something that you would want to reach out to us about, and we could dig in it too.
Awesome. A couple of just quick questions that are easy to answer. Some folks asked whether we're available in Canada. Unfortunately, we're not yet today. Wish I had a recommendation for you there, but just less familiar with that market. And then also for nonprofits, we do not serve nonprofits today. We recommend, though, there are some brokers that are actually very specialized in the nonprofit world. So if you want to reach out at hello@vouch.us, I'm happy to have our team pull some recommendations for you there. I think a question that feels very relevant for a lot of folks, people wondering how do you identify the right amount of cyber insurance is for your business, whether it be $1 million, 10 million, and the answer is it is different for everybody. I'll tell you that it is typically the requirements that you get from customers are going to be the highest sort of bar in the equation, and oftentimes that's what drives the decision, unfortunately. However, there are a number of factors you can look at. So we think that, for instance, digital health companies obviously have more substantial cyber needs because you're handling typically HIPAA data, et cetera, than your typical maybe consumer business. One key factor that's important is PII. If you're collecting personally identifiable information, then it's really important that you have, again, substantial cyber coverage in place. And so coverage can start as low as $250K or $500K for businesses that have really basic data protection needs that maybe aren't collecting substantial PII. But then we would want to see companies, particularly if you're collecting sensitive information, step that up to $1 to $2 million in coverage that should cover most early stage companies. Was there anything else you'd add to that?
Yeah, I definitely think it's there's two main pillars really in thinking about it. One is going to be contractual requirements, because that is certainly a driver in a lot of decision making for insurance, unfortunately. I don't think it should be the number one driver, but it is, as well as the type of data, as well as the amount of data that you may be storing or partners that you work with may be storing. Those definitely do drive the decision as to how much coverage you should be buying based on your organization. And it's something that you should reevaluate continuously as you grow. It's not to say that you should wait 12 months to increase your limits. If in 6 months you've tripled in size, it's certainly something that you should reevaluate in real time.
We just got another question asking, how is Vouch different from Embroker or other digital broker platforms? So happy to address that. Frankly, Embroker and other digital broker platforms focus on many different verticals, right? So whether it be lawyers, accountants, startups, you name it. And some folks have certain products, if you will. and do a little bit of what Vouch does, but nobody does the end-to-end experience in the way that we do it. Everything from property and general liability through the needs that you have as you scale, everything through one simple membership versus working with sort of multiple carriers in the background most frequently. And so with that, I think we're up on time, but please don't hesitate to reach out to our team at hello@vouch.us or vouch.us/Atrium to access your discount as an Atrium client.
Great, guys. This is Eric again. Thanks again for joining us. We'll be sending out the link to the recording and the slides after this. So if you had any audio issues or couldn't see the slides, you'll definitely be getting a copy. Again, thanks again for joining us today, and we hope to see you at our next recording.